Welcome to a very special 100th episode of Critical Thinking, Mercer's regular deep dive into the big issues, market outlooks, and economic trends that are shaping portfolios today. I'm Niall O'Sullivan, the the global CIO for Mercer, and delighted to be joined by a very special guest, one of the biggest names in the world of economics, Dr. Janet Yellen. When I was trying to think about how I would also introduce your career, but also how I'd address you if we're getting ready for today, I was looking through it. I could have chosen, chair of the president's economic advisors, chair of the Federal Reserve, secretary of the Treasury. But I think I was told today I can just go with Dr. Yellen for the purpose of the conversation. But as we kind of look at that and look at back in that career, I'd like to begin where your economic imagination was first sparked. I'd love to hear about your early life in Brooklyn and later how the experience in the PhD class in Yale helped shape your worldview.
Well, I grew up in Brooklyn in an area called Bay Ridge, and Bay Ridge was very close to the waterfront, to the docks. And my father was a family physician. His office was in our home. And he got out of medical school, finished his residency during the Great Depression, and he wanted to go into private practice, and he wanted to find a place to hang out his shingle where he'd find people in need of a physician. And he thought this area by the docks, there was a lot of manufacturing, shipping, many blue collar workers who worked there. And he thought these are people um, that I could be a family doctor to. And so he bought a house that was just a very short bus ride from this area where the people worked. And because his office was in our home, I met many of his patients and knew them. And he talked about the issues that they faced. And one of the issues was unemployment and, the ups and downs of the business cycle. Um, they often lost their jobs, they were laid off. And my father would talk about the impact that these layoffs had on his patients, on their families, and how devastating it was when people lost their jobs. That that it was sort of more what I remember being impressed by was how much more it was than just the loss of income. It was sort of loss of self-respect, family tension, psychological problems, health issues that sort of jobs were wrapped up with people's identities and um, that not having a job was a profoundly difficult thing for people and families. And my parents had grown up during the Great Depression, and so that was a theme for them as well. So unemployment, labor markets, something very important for me when I was growing up. Um, then I went off to college, studied economics. Um, Learned about Keynesian economics, which really was an explanation of why societies that are capitalist, market based economies, why it was that they could suffer shocks that led to large amounts of unemployment for prolonged times. Events as, dreadful as the Great Depression or the unemployment, the Great Recession we had after the financial crisis. But I began to understand what it was that caused that and what could be done about it. And really, monetary and fiscal policy could be used to address this and alleviate a lot of suffering. And that became the theme of my career, and it's really what I spent most of my career doing. Um,
And it's clear that that driver, that North Star, has always been people, especially those vulnerable to economic shocks. When you faced the crisis along the way, like, for example, the financial crisis, the pandemic, how did that influence your thinking?
well, I was always focused when unemployment's high. There are people out of work, um, always focused on how to get them back to work. What do we need to do to alleviate the suffering and at the individual level and to cure the economic problem that has led to significant unemployment. So, I mean, the financial crisis in 2008 was just devastating. And when you have high unemployment for a very long period of time, it's usually because there's a shortage of spending in the economy. And the question is, how can you boost it? And fiscal policy running deficits, you're adding to the spending of the economy. And monetary policy lowering interest rates can drive more investment spending or encourage housing, and the mechanism is we're trying to boost spending. And when you do that, it creates demand. When people are hired and earn income, they turn around and spend some more. And it gets a process going that can lead you back to full employment. So, during the time that I was at the Fed, and we were living through the financial crisis, and I had various positions from 2004 to 2018. Um, th- the impact of the financial crisis itself was really catastrophic on household wealth, budgets, ability to spend. On the financial system, credit was scarce. It was hard to qualify for loans. The value of housing is collateral. There were homeowners who were underwater on their mortgages. It had a profoundly negative impact on spending, and it was hard to get the economy going. The overhang from the crisis was so large. And by December of 2008, we had lowered short-term interest rates to zero. And the economy had close to double-digit unemployment. And the question was, is there anything left we can do? Because managing short-term interest rates is the Fed's main monetary policy tool. And I would say my own textbook in graduate school said, when the interest rate gets to zero, you're finished. That's it. There's nothing more to do. But we felt at the Fed it behooved us to think harder about that. And what we noticed was that long-term interest rates were still significantly above zero. And we asked ourselves, can't we do something to bring those down? And that would lower mortgage rates, lower borrowing costs for companies and the like. And we devised two ways to do that. One involved um, purchasing long-term assets like treasuries and government-backed, mortgage-backed securities, with the idea that if we took some long-term assets away from the public, we bought them up, we would drive up their prices and lower their yields. And I believe that worked. The other thing we realized is that long-term rates, in part, what investors demand to hold a long-term asset depends on their views about what short-term interest rates will be over the life of that asset. And so the short-term interest rate overnight was zero, but maybe people thought that only lasts for a year or two and then they'd go back to normal levels. And that view was holding long-term rates up. Now, as it turns out, it took 7 years for short-term rates to rise above zero. And so we thought this was a false expectation. And we thought hard about what kind of information could we give the public about our plans, our assessment of the economic trends and our forecasts, and our monetary policy strategy, and how we would be thinking about this decision that would influence their views. And so we spent a lot of time on our communications. We adopted an numerical inflation target. Some other countries had one, but the United States never had. And I think that helped market participants better understand what our strategy would be. We began to publish the forecasts of individual members of the FOMC for what they thought the path of rates would be over the next 3 to 4 years and in the longer term. And gradually, these communications began to affect market views as well. Still, it was almost a decade before unemployment dropped to 4%, but that was very much our focus.
And when you look at, there's obviously decisions you make are always about trade-offs, and then we roll forward to the pandemic, and you use the tools across the things that were at your disposal. But obviously, that led to a surge in inflation
Yeah.
afterwards. How do you respond to people that say that, you know, you made the wrong trade-offs, or how do you think about that in
Well, I
retrospect?
mean, it's certainly a valid question. Over 2 years, a little bit more than 2 years, the average level of prices rose by 20%. And that was profoundly disturbing and shocking to um, many Americans. Now, I will say wages went up as well. No, not for everybody, but um, especially lower income, lower wage Americans got bigger raises than the average, but still this had profoundly negative impacts. So I guess what I'd say is we decided to have a large fiscal package to address unemployment and all the suffering that the pandemic was causing. And we didn't want people to be scarred and have such profoundly negative labor market experience that they would never that it would really derail their lives. We'd seen that after the financial crisis. Um, did it was it partly responsible for the inflation we had? Yes. But I would say only a small part. I think we were not going to escape. It was unrealistic to think that we could escape a meaningful amount of inflation. In fact, a large amount of inflation. And every developed country experienced similar amounts of inflation, whether they had expansionary fiscal policies or they didn't. And it was because of first um, dislocations caused by the pandemic, huge shifts in spending away from services, going out to eat at restaurants and the like, and toward goods. And the our whole global system just didn't have the capacity to shift its production that quickly into the goods people wanted. And we encountered outright shortages. An example being we just ran out of semiconductors. And American auto firms, they had to close assembly plants because they couldn't get the semiconductors to produce autos. So it were profound dislocations that caused shortages, the kind of shortage you almost never see outside of a war situation. So there was spikes in auto prices and other goods prices that I don't think could easily have been prevented. And then Russia invaded Ukraine, and that pushed up global energy prices and food prices, and most countries suffered that as well. You know, to have avoided that inflation, it's we wouldn't it couldn't have just had a somewhat smaller fiscal stimulus. We would have had to have fiscal contraction. We would have that would have pushed up the unemployment rate even higher than it was when we took office. Would that really have been worth it? Is that to get rid of that price bulge? Would we have really thought it was something to have 10 to 15% unemployment? I wouldn't have. It's not a judgment I would have made. Perhaps some would, but I think that's what it would have taken.
And if we roll forward to today, economic volatility, as we know, what makes you confident about the American economy today? Like, are the foundational elements of the financial economic system there to give confidence in the future? And I suppose as a private citizen, what's keeping you awake at night?
Well, I think there are fundamental strengths of the U.S. economy that have made our economic performance exceptional. Um, you know, even you can see it even in the aftermath of the pandemic. The United States has had the strongest productivity growth by an order of magnitude of any developed country. And why is that? Many During the pandemic, many countries, they were worried about unemployment, and they thought, we have to preserve the attachment of workers to firms. They paid firms not to fire workers, to keep them in their jobs, keep them on the payroll. We didn't really do that to any great extent. We let workers be fired. We had generous unemployment insurance, but um, workers move, they changed. We have flexible labor markets. We are capable of having a lot of reallocation of labor. I think that reallocation of labor, it took a while to settle down and for people to find new jobs and become attached to them, but I think it's one of the factors that's boosted productivity. So we have very dynamic and flexible labor markets. We are really terrific on innovation. Um, Even in the aftermath of the pandemic, we had record formation, business formation. Innovation is strong, and everything that supports innovation, venture capital, private equity, we have deep, resilient um, capital markets that channel capital to new innovative businesses. Our it, pace of innovation. We have, strong universities, support for R&D that generates commercially important applications. So our whole culture around innovation. And then we have the deepest capital markets. Our Treasury market is essentially the core global financial market that underpins much of the world's um, saving and investment. And, we've generally had good economic policy um, that's capable of responding to shocks in a way that's constructive, the rule of law. Um, our currency is used as the world's reserve currency. That gives us what's called an exorbitant privilege, which is that we can borrow on exceptionally good terms and it flows through really to everyone in the economy. And these are fundamental strengths of the U.S. that I hope will always be there.
Dr. Young, it's been an absolute pleasure. Thank you so much for your insights, for sharing with the audience. Thank you to the audience for listening and to it also. If you like what you've heard, please don't forget to like and subscribe on whatever platform you're listening to. And if you have any questions on any of the subjects discussed, please don't hesitate to reach out to your local Mercer contact. Thank you very much.